Thanks. Thanks, Michael, with the PowerPoint. We got somebody really excited about PowerPoints out there. Make sure you're just choosing all panelists and attendees so that everybody can see it, because there's a lot more activity in here that people may know. On the yield curve, real quick, I want to honor this question from Mitchell. Inverted yield curve has been right 90% of the time in history. He goes on to say, plus we are starting to see debt-driven growth companies fall flat on IPO, indicator of stock market top two. Mitchell, those words mean that you're way smarter than I am. I think I understood half of those, but we'll let Jay opine on this stuff. So
yeah, so this one's important because people really, I probably, again, beat this horse a little bit too hard, but people like this because you can go to a party and can actually have a discussion about it, and it becomes more interesting when you really understand it. So two important things about the yield curve. First thing to understand is the way the government raises money is that they sell bonds. Bonds are basically, for all of us real estate investors, they're basically notes. It's debt. The government says, here, you give me money and I'm going to pay you back that money plus some interest rate. And for bonds, we refer to that interest rate as a yield. So the yield can be 2% or 3% or 4%. It's basically the interest rate. The government says, lend me $10,000 and I'll pay you 2% or 3% or 4%, whatever the amount is. That's the yield I'm going to pay. So that's how the government raises money. Number two, the government sells different length bonds. They sell bonds that expire in 1 month, which means you're buying a bond and you're holding it for 1 month. The government's going to pay you 1 month of interest or yield, and then you don't have the bond anymore. They pay you back your full principal and you're done. But they also sell longer durations. You can get 2 months, 6 months, 12 months. You can get 5-year, 10-year. You can get all the way up to 30-year bonds. So if you want to put your money someplace safe, and a lot of people think this is the safest place in the world to put your money, U.S. government, you can buy a 30-year government bond, and the government's just going to pay you interest for 30 years, and then they'll pay you off. So you have short-term bonds, you have long-term bonds, you have medium-term bonds. What drives the yield or the interest rate for each of these bonds is the market. It's supply and demand. But typically what we see is that short-term bonds, so this data point here is a 3-month bond. Short-term bonds tend to pay lower yields or lower interest than longer-term bonds.
Makes sense.
So the longer you go up in bonds, or the longer the duration of bonds, the higher the government's going to pay you, or the higher the market's going to pay you. It's not really the government setting the price. And the reason for this is if I said to you, hey, I want you to lend me money for 3 months, you might be willing to do that at a low rate because it's not much opportunity cost for you. You're not losing much if rates go up in that time. But if I said, I want you to loan me money for 20 years, you're going to say, you're going to have to pay me a little bit more because in 20 years, interest rates could be 10 points higher. I could have a good investment that I'm missing out. So you need higher rate to lend for a longer period of time. So what we see here is that if we plot the graph of interest rates, the duration. So on the x-axis, the horizontal axis, we have the duration of the bonds. And on the vertical axis, we have the interest rates. This was taken in January 2004. What we tend to see is we have these points that go from the lower left-hand corner up to the upper right-hand corner. And if we connect these points, we get a line. We have to refer to this as a curve. This is a yield curve right here. So what we see back in January 2004 is the yield curve started in the lower left and it went up to the upper right. This is what a typical, normal, healthy yield curve looks like. This is what we see in a typically a strong economy. It's exactly what we expect. Now, when the economy starts to do different things, okay, sorry, I haven't used these slides in a while. So this is what we want to see in a healthy yield curve. We want to see it go lower left to upper right. Yep. Now, sorry. Okay. Now.
It looks good. It looks good.
I'm sorry. It's the video window is covering the words. I didn't see it come up. Okay. Now, when investors get scared, when investors get nervous, when the people that are investing in treasury bonds and the people that invest in these bonds, it's not you and me. We don't have enough money for the most part. These are big investors that are putting millions of dollars in. These are companies like Microsoft buys treasury bonds, hedge funds buy treasury bonds, China and other country governments buy treasury bonds, like serious money, people that really like influence the economy. When these people start to get scared, two things happen. One, they say, we don't want as much money in our short-term bonds. We want to move them to long-term bonds because we want safety. We're not investing for 3 months. We're concerned that the economy is going to collapse. And when the economy collapses, interest rates go down, bonds don't return enough, and we don't have other investments. So when investors start to get scared, they start buying up these long-term bonds. And supply and demand. When everybody wants these long-term bonds, bonds don't need to pay as much because everybody wants to buy them. So the yield, the interest rate for these long-term bonds starts to drop. The second thing that happens when investors start to get nervous is they stop buying these short-term bonds. They want to put their money someplace safer. And generally, it's long-term bonds. So when they stop buying these short-term bonds, what happens when you stop buying stuff? The price goes down. And with bonds, price down means interest rates go up. So when investors get scared, we see two things happening. We see the yield or the interest rate for long-term bonds drop. We see the yield or interest rates for short-term bonds go up. So this was 2004. This was March of 2006. And we all know what happened about 2 years after this. The interest rates or the yield for short-term bonds went up a bunch, long-term bonds went down a bunch, and it flattened out in the middle. And this is what we refer to as a flattened yield curve. Typically, when we see a flattened yield curve, that's a sign that we're probably not imminently in danger of a recession, but that tells us that investors, people that have a lot of money, are starting to get worried. So this is what 2006 looked like, up and down. This is what August, just a few months later, looked like. And at this point, you see that the 3-month yield and the 20-year yield were both higher than the 5 and 7 year yield. So basically, people were moving a lot of money out of short-term bonds, good bit of money out of like the 2 and 5 year bonds, and putting them in all the 10 and 20 and 30 year bonds. And what we see is a curve that kind of a U-shaped or an inversion. And this is what we refer to as an inverted yield curve. And so typically speaking, when the 2 year is greater than the 10 year, and in this case, in August 2006, they're about the same, but when the 2 year is greater than the 10 year, that's when we say there's a 2-10 inversion. And somebody, I don't remember his name, but whoever it was that mentioned that 90% of the time when we see an inverted yield curve, it leads to a recession.
Mitchell, yeah. Yeah,
90% of the time over the past 60 years, all but 2 occasions when we've seen a 2 and 10 year inversion, there's been a recession within 18 months. So
wow. Okay.
That's what the yield curve is. Now, is this time going to be that third exception? Or is this going to be in the 90%? We don't know. Maybe there are people that'll say, well, the yield curve doesn't mean as much anymore. This time is different. There's always people that are going to say this time is different. They may be right. I'm not going to say I know more than they do, but there are always people that say that this time is different. I tend to think that history is a better predictor than emotion. So I don't know if this time is different or not. But about 3 weeks ago, we saw this 210 inversion for the first time since 2006. And so a lot of people think that we are within between 6 and 18 months of a recession simply based on this one piece of data.
Makes sense. That makes sense. I got to be honest, there were moments in there where I forgot that there were other people. Like you had me kind of captivated on that because I've never seen this explained. Well, I've never seen it explained, period, probably, but especially not that well. People have explained it, but it always is a little bit like, okay, I kind of get that, but that makes complete and total sense.
Cool.
Right. Yeah. So a couple people are saying, wow, this is really good explanation here. So, all right. So you've got the GDP kind of slowing or steady, whatever, like you said, whatever side of the aisle that you're on, essentially, right? You've got the yield curve inverting.
Yep.
So these are the data points. Are there any other data points that you look at that you consider for whether or not anything is coming, or are those kind of the big two?
No, there are a lot. I'm not going to go into all of them. Let me talk about a couple of the biggest. I'm going to come back to this PowerPoint because this is another interesting one that people might like. Well, is it not in this one? It might not be in this one. Okay. Okay. Well, here are some of the things I like to look at.
Oh,
So
wow.
yield curve's the big one, and that's one we hear everybody talking about. One we don't hear people talking about as much, but I love this one. It's called the Buffett indicator, and it's because Warren Buffett is a big fan of this piece of data. And I'm not going to go into the details, but long story short, Warren Buffett believes, he didn't invent this, but he's a big believer in it. Warren Buffett would say that there is a direct relationship between GDP, which is the total output of the country. So that thing that we were talking about earlier, and the value of the stock market, the value of all public equities in the United States. And that if you mapped, or if you took a ratio of GDP, compared it to the value of the stock market, that we want to see a ratio of 0.9. So that's kind of the healthiest ratio.
Okay.
And so if the value of GDP, 1 year's GDP to the total value of the stock market is around 0.9, then he would say the stock market is valued correctly. If that ratio is less than 0.9, he would say the stock market is undervalued. If that ratio is over 0.9, then he would say the stock market is overvalued. And historically, if you look at the trends in the stock market, the ups and downs in the stock market, the historical average of GDP to total value of the stock market is somewhere around a 0.9 ratio. So a lot of people will say when the Buffett indicator, this ratio number, gets above, so 0.9 or 90% is kind of the baseline. When it gets above 100 or 110, the stock market's a good bit overvalued and you should be concerned. If it gets below 60 or 70%, it's a good bit undervalued. Today, so if you go back to 2008, we got to 135% back in 2007. As of, and I haven't looked at it in about a month, but given where the stock market's been the last few days, I'm guessing we're somewhere around 145% right now. So if you were to ask Warren Buffett, assuming that he still believes in this metric, he would tell you that the stock market's probably overpriced by about 40% right now. And there are a lot of people that look at this metric. Now, again, does that mean it's going to drop back to the 90% or 0.9 tomorrow or next week or next? Nobody knows. And maybe it'll drop back to 1.2 or 120%. Or maybe it'll go up to 160 before anything happens. We don't know.
Right.
But the fact that it's at 140%, if you believe in historical data, if you believe in averages, that tells you the stock market is probably a good bit overpriced right now compared to where our economy, our GDP, our total output of our economy is right now. So that's the next. So that's a bad sign. Yield
Crazy.
curve. Yeah, so yield curve's a bad sign. Buffett indicator's a bad sign. GDP is mixed. Unemployment's an interesting one. So unemployment, as everybody talks about, is still historically strong. There's certainly some things we've seen over the last couple of months that have said things are slowing down. The number of jobs added is reduced and stuff like that. But at 3.7%, the unemployment rate is strong. Certain sectors of unemployment, it's stronger than it's ever been in history. So unemployment is kind of a bellwether metric here. There are a lot of things that are pointing to the economy showing cracks and maybe starting to turn down or starting to soften, but unemployment's been historically strong. If you look at things like the foreclosure rate, starting to tick up. If you look at stock market volatility, we've seen a lot of stock market volatility, though again, plenty of people will say that has nothing to do with the economy, that has to do with just other things that are going on, political things going on. Housing starts. So a good indicator of the optimism of builders is housing starts. So how many new housing projects are developers starting on? Because if you think about it, a developer isn't going to start on a project today if he thinks there's going to be a recession in 6 months. Typical housing is going to take 12 to 18 months to come online from the day you submit for your permits. And that's what the housing starts number is. So if that number is strong, that says developers are pretty confident for the next 12 to 18 months. Well, housing starts have been pretty strong the last few months. There was a dip earlier in the year. There was a dip in home sales. There was a dip in inventory, or an increase in inventory. There was a dip in housing starts. A lot of people back in January, February, March were saying, okay, this is it. This is where everything starts going down. But June, July, August, all these metrics got better. So So very mixed on housing starts. Long story short, when you look at all of these things, if you look, here's another big one. A lot of people have been pointing to there are certain industries in our economy or certain sectors of our economy that are acting weird. So manufacturing is a good one. So manufacturing is at its lowest point since 2008. So a lot of people would say manufacturing, as of last month, as of August when the numbers came out, we've had 3 months of negative growth in manufacturing. That indicates manufacturing is in a recession. Okay. But you look at tech, you look at energy, those things are still really strong. So you're seeing a lot of mixed signs. So not uncommon for when you're at the top of the market, you're going to see some good indicators, some bad indicators. You're going to see trends in different directions, things. And then the next big question is people are looking in their own market, especially us as real estate investors, and they're saying, okay, my market is strong. I mean, I'm selling lots of houses, I'm buying lots of houses, values are up, inventory is down. But then you go out to other markets and people are like, yeah, we've seen a 25% drop. I was in Seattle a couple months ago and they're talking about in certain parts of Seattle, they've seen a 25% drop. San Francisco's seen a 15% drop in prices and inventory levels are through the roof. And so what we're seeing is we're seeing very mixed demographic and location, geographic signals. Certain economies are doing really well. I like to look at employment rate, job growth, population growth, wage growth. And if you look at those things, some areas of the country are holding up really strong. Things are looking really good. Other areas of the country are starting to turn down. So again, everything I'm looking at is basically telling me we're kind of in a mixed bag. We're at the top of the market, and it's just a question of what's going to tip us over, and is that going to happen next week, next month, next year, or 3 years down the line?
Wow.
I don't know.
Well, right, but I mean, clearly there are some. Well, okay, clearly there are some incredible indicators to say, be mindful here, be smart.
Yep.
And one quick question before, because I want to ask you, like, so if you're going to flip a house now,
yeah.
what do you do to protect yourself if you're going to get? This is a multifamily group primarily, so if you're going to go long and buy a multifamily property, I want to talk about how an investor protects themselves. But one question that popped up in here was around where you get this data from. So where are you? Is there a .gov somewhere that you're getting most of this data from? Like, what would you recommend people dive into to get more of this?
Well, I'm going to take 1 second. I'm going to plug something real quick.
Go for it.
And only because it's really highly related. I wrote a book about 6 months ago called Recession-Proof Real Estate Investing. And it's basically all about economic cycles, the history of them, how they work, what drives them, what causes cycles. And it's basically kind of a crash course on economics. And then it talks about all these data points. And then finally, the second half of the book is how do you modify your strategies and your tactics in real estate to take advantage of different parts of the economic cycle. So if we're in the top of the cycle right now, what should we be doing and not doing strategically and tactically to really maximize our profits, minimize our headaches? During the recession, what do we do? At the bottom of the market, what do we do? During the expansion, what do we do? And I kind of analyzed each part of the cycle and talked about the different strategies and tactics that really go into shoring up your real estate business so that you can maximize profits.
Okay.
And even more important than maximizing profits, especially at this part in the cycle, is reducing risks. So anybody that wants to check out that book, Bigger Pockets has it. It's on Amazon as well.
One more time, Recession-Proof Real Estate Investing, correct?
That's it.
Perfect. Somebody asked about what the name of the book was. So, okay. So like you mentioned, we're at the top. Your sense is that we're at the top based on the data that you looked at and the other indicators.
Yeah.
So if we're at the top, if you could give us a bit of a preview into that part of it, because you mentioned you kind of outlined it by cycle. If we're at the top, what does a flipper do? What does a long-term multifamily investor do? If you will, that's maybe a little too basic a question, but I think
that's a perfect question. So if you want to flip houses at this point in the cycle, and I don't necessarily, if somebody wants to get into flipping houses, it's a tough time. You're going to be increasing your risk. Can be done, absolutely. I'm still flipping houses. I know plenty of people flipping houses. There's no reason why you can't get into it, but expect that your risk is going to be higher if you jump into flipping houses right now than if you jumped into other things like rentals or notes or whatever. We can talk about those. But if you're going to do flips at this point in the cycle, couple recommendations that I would have. One, keep your projects quick. So typically speaking, we get some notice before a recession comes. 2008 was one of those weird ones where kind of everything crashed overnight. I mean, February, we saw the stock market tank, and by April, I mean, the whole economy was in shambles. So, but typically speaking, there's a few month transition from like good economy to bad economy. We see some bad unemployment numbers, and we see some low inflation and low wage growth, and we haven't really started seeing that. So if you can keep your projects quick, you're probably going to be a lot safer. So don't take on the major, don't take on building new construction. Don't take on adding a second story or doing an addition on a house. Stick with stuff that's you can get through the permit cycle, the renovation cycle, and the sales cycle relatively quickly. I like to keep my projects at this point in the cycle under 3 months. I want to be in and out in 90 days. Now, 2 years ago, I was doing big projects, additions, pop tops, where you add a second story, that I would spend 90 days just getting permits. I'd spend 6 or 12 months getting permits, and it ended up being a 1.5 year project. I won't do those anymore. I'm sticking with the projects that I can be in and out in 90 days. So that's number one. Number two, I'm a big fan of knowing your market. And 2008 was actually a great set of data for investors. So I like to say use 2008 as your worst case scenario. And I'm not saying it was, who knows, at some point there's going to be a worse than 2008. And it could be the next one. Statistically, probably not. So I like to say use 2008 as your worst case scenario. Let me say this another way. 6 months ago, I was in Maryland, and I was flipping houses in Maryland. And I was saying, okay, I feel like the economy is starting to turn. I want to be careful. I went and I got myself really familiar with what happened in Maryland in 2008. And what I found is that on average in Maryland, housing dropped about 18% in 2008 in the areas that I was. It was actually it was a pretty good area. It didn't get crushed like a lot of places. So 18% was that number. So if I assume that I'm flipping houses in a market that back in 2008 saw an 18% drop in prices, I can then say the next coming recession, the worst case scenario is likely an 18% drop in housing prices. Probably not that bad, but let's call that our worst case scenario. If I go into every flip with a profit margin of greater than 18%, then even if we see a worst case scenario in that market, I should at least break even. So I like to say, what's my risk profile? I don't want to lose money. I don't care if I don't make money, but I don't want to lose money. So when I'm flipping in Maryland, I'm making sure I have 18% profit margins.
Which makes sense.
Yeah.
Yeah.
And so every market's going to be different. If I'm going to flip in Georgia right now, well, worst case scenario there was more like 30, 40, 45% in certain areas. So obviously I'm probably not going to find deals that are returning 30 or 40%. But generally speaking, if I'm going to do flips in Georgia, I want to see higher returns than I want to see in Maryland because there's greater risk based on the worst case scenario of what happened 10 years ago.
Okay. On that point real quick, because Michaela has a question in the Q&A section that I want to get to. I think it's pretty good. She's a couple, and I think it's along the lines of, it is along the lines of this. She's got this duplex that she's been chipping away at renovating. It's pretty much done, a couple cosmetic things. And her question is, she wants to refinance. She doesn't know if she should get everything done first, take the time and then refi or refi now and take that cash out. You're talking about flipping, selling. Does anything change in your advice around if you were to kind of flip and hold, like Burr, essentially? Is anything change in that?
So completely different strategy. So one, let's talk about rentals in general. So